and welcome to Beat Street, the show that gives you the tradable news and data you need ahead of the Wall Street Open. Coming up, stocks glow. Global equities continue to bask in the glow of Nvidia's results and signs that the US economy is humming along nicely. And hot cocoa prices hitting new highs amid production woes. Not just down to the weather, but also due to disease for the crops. And 2 years on, we take a look at the impact of Russia invading Ukraine. Very good afternoon to you. I'm Angeline Ong, and welcome to this edition of Beat the Street. Not long now before Wall Street starts trading, it was looking like quite a cautious start earlier. Just showing you the Dow Jones Industrials here, giving you a view of the 15-minute chart as well, because as you can see there, it is trading sideways as we count down to the open. But who can blame traders out there after that meteoric rise in terms of Nvidia's market cap? Also, what's been key has been the resilience of the US economy. So far, all the data is pointing to ongoing strength for the US economy, and that in turn has been affecting the first rate cut expectations from the Fed. Joining me now to talk about this live from New York is John Stoltzfus from Oppenheimer. Thank you so much for joining us so early in your day, John. I guess you've always been calling for a cut in the first half and not like in spring when everyone was getting excited in the latter part of last year. But what are we talking about? What are your expectations now, Q3, Q4?
Well, we have expected since the end of last year, when the Fed intimated that it would cut rates around 3 times in this year if it looked like it could. We thought that was about right. We thought maybe it would even cut fewer times. And we've been looking for cuts likely in the second half of the year, and possibly as late as in the fourth quarter. The market seemed to believe that it would be something like 4, 5, 6, 7 cuts, and it positioned itself so. And you can imagine leveraged players got quite burned as the Federal Reserve pushed back on that. And we now see that the market has generally, through all the capitulation we've seen originally from bears, then for those who expected that the Fed would cut earlier, everybody seems to be getting on the beam and beginning to believe that the Fed indeed is saying what it means. And we, as long-term observers of the Federal Reserve, I've been in this business for 40 years, we've believed for a long time that the Fed, since Bernanke, essentially telegraphs its punches or guides the market as to where it plans to go. It's just that the market doesn't always believe it. But that said, this is an excellent period where the Fed understands its mandate very well. It operates very sensitively. It has, in the last 2 years, raised rates 11 times and paused for after 5 FOMC meetings, but delivered its mandate on a very sensitive basis, so that even as it has removed emergency liquidity from the system, it has not pushed the U.S. economy into a recession with, as you just mentioned, its business, the consumer, and jobs all being resilient in the economy. And we think resilience is the operative word that the Fed wants to see here. Resilient economy, while it continues to look to keep inflation in check, moving towards that 2% target eventually.
John, what would you say to those watching that have positioned prior to this for a spring, and then they moved their positions so that they're now positioning for June? What would you say to them holding those positions? Should they unwind them, or how should they hedge their bets?
Well, I think that's what we did see. Those that were looking for earlier cuts by the Fed have been unwinding positions, and in that was that volatility that we experienced since the beginning of the year. Once we got into it, we had the market ticking higher. Then we saw some volatility. We saw people flow into bonds. We saw the 10-year yield come down, and then all of a sudden, the reality of the fact that the economy was stubbornly resilient it showed that the Fed would likely be on pause for longer. So this is a process. We think a lot of the unwinding has likely happened of that overly optimistic trade that was in the market. And much of that because margin costs a lot more than it used to. As we've often said, it's the end of free money, and it's a good thing. Bond issuers have to pay for the privilege of borrowing money. Bond buyers get something in return in terms of a coupon, and that occurs from the short end of the yield curve to the longer end. It's a more normalized environment, and we think people are beginning to get that message from the Fed.
Thank you very much, John. I'm sure we'll be checking in with you when the next recalibration happens. Have a really good weekend. John Stoltzfus there from Oppenheimer, all the way from New York. Now, it's been 2 years since Russia invaded Ukraine. Let's just take a look at where we stand now that NVIDIA sort of excitement is slightly now coming down. This is a look at Wall Street first, which mirrors the Dow Jones Industrials, and I'm showing you this for a very good reason. If you trade major US markets and you don't really follow the headlines, then really you would be forgiven for not knowing that there's still 2 ongoing wars. Just trying to show you where it's a bit tricky with per real time here, but just bear with me. It was 24th of Feb, but it lets me put that line on the 25th. There you go. It doesn't seem to want to stick there. But as you can see, it's been quite tumultuous, but it has really come quite a way from that level. If I can chart that for you, look at that rise there. And really, if you didn't have newspapers or TVs and you just looked at the gain there, you would think that perhaps nothing was going on. But of course, there are still 2 ongoing wars, and it has impacted many parts of the world. Just also showing you Brent crude, because crude as well is another interesting chart, because after the invasion there was a big spike there, but as you can see, it's very much a demand-driven picture and demand-driven chart there too. And I'm trying to draw this line for you to further amplify this, because if you look at that, it is quite a clear downward trend channel. And there are many traders and analysts out there that cover the space that said if the US economy and certainly the Chinese economy, well, if they don't start picking up relatively soon and significantly, then we could see further downside for oil prices should supply not be crimped. And as you heard from John Stoltzfus from Oppenheimer earlier, the Fed has kicked the rate cut can further down the road. And recent manufacturing data also suggests that green shoots of growth are emerging in Europe and the US as well. All this affecting the US dollar, which I'm showing you now, the US dollar basket, there you have it. And yet again, we can see here that we had pretty much a big rise in the dollar after the invasion. But after that, around this time in September 2022, it's really come off that level and continues to show downside trend lines, which suggests that perhaps the dollar, especially with the Fed now dialing back those first rate cut expectations, it could have further downside to come. And while we initially saw a spike in agricultural commodities like corn and wheat, well, let's show you corn right now, because there are now concerns that many US farmers have called the market wrong, and now they have too much corn in the silos. As you can see there, yet again, a spike there when the war first started. However, it has slid quite dramatically since then. Throughout the last year or so, Ukraine and Russia have been sharing headlines with the so-called Magnificent Seven, with NVIDIA very much being at the epicenter of that story. And just showing you the chart of NVIDIA here, because it's gone parabolic. I mean, if you try to draw a line, well, that's not quite going to work really, because it has risen quite remarkably and confounded many of those in the market that have said that this is gravity defying. It's got to come down at some point. But as you heard John Stolfers say earlier, some in the market believe that perhaps this is the start of a new revolution, and very much like the cars, and when Ford created the Tin Lizzie and commercialized and made cars affordable for everyone. Now, talking about one commodity that has been affected and continues to show this effect, well, that is gold. And we've been watching that rather closely. Gold also being lifted by what's happening in the Middle East. And Sean Morrison has been looking at the technicals a little closer for us.
Price of dollar-denominated gold is showing an inverse correlation, as it often does, with the US dollar, which has been strengthening, at least in the short term, as well as US Treasury yields. Now, what we do have here is a longer-term trend on gold, which is sideways, but as a function of this very short-term move down, we have this bear flag type formation. This bear flag formation is a suggestion of that trend which preceded. So we look at this move down being continued. And the moment we do wait for the breakout, and at the moment we do have a bit of a breakout. We have this red candle closing below. Now, today's candle is not finished. It could change. It could move back up into this pattern, and it wouldn't be relevant. But the way it stands now, if it was to close a little bit lower, the assumption is for short-term decline in gold, we'll be targeting move back towards about that $1,990 per ounce initially. If we do get that, then we might look at having a stop loss on the close above that reversal high there at about $2,035 per ounce.
And here's a rough calculation of gold since the invasion. Russia invaded Ukraine 2 years ago. And as you can see here from my chart, there has been a gain, and Sean Morrison with the nearer term technicals there. Now, it's a big week, the one coming, not just for economic data, but also on the corporate side with eBay in the US reporting. Earlier, we spoke to Tomatica's Chris Versace and asked him what his market moving events were in the coming week.
So next week, it's the typical end of the month, start of the new month kind of data. So from a data perspective, we'll get the final read for January manufacturing PMIs, not only from S&P Global, but also from ISM. That'll go a long way to telling us more about the speed of the economy, job creation during the month of February, and a more concrete look at those inflation indicators in both of those reports. But we're also going to get the January PCE price index. This is important because it is one of the Fed's preferred inflation metrics. The core PCE is expected to tick down. But again, given all the data that we've seen so far for January, if it ticks the wrong way, I think that will be another indication that the Fed is going to wait even longer than the market currently thinks.
Chris Versace there from Tomatica. Now, just a quick look at Wall Street, Dow Jones Industrials, as we count down to the cash open. As you can see there, quite a bit of caution, subdued really after that scorching AI-led rally, thanks to NVIDIA, AI poster child, NVIDIA. We'll have more analysis for you in the coming week, but until then, have a good weekend. This is IGTV.